Imagine turning your trading reactions into calm, confident decisions every single day, starting right now. In this video, we explore a 90-day trading psychology strategy. This strategy can change how you approach each market session. This is a step-by-step plan to strengthen your mindset. It will sharpen your discipline. It will build emotional control you need to survive. It will help you thrive in the markets. We will explain how to manage emotions so fear and greed stop sabotaging your trades. We will explain how to build rock-solid confidence in your strategy. We will explain how to develop discipline and steady consistency. These traits separate successful traders from the rest. If you are serious about improving your trading, listen through and apply these ideas consistently. Let us be honest about one thing. Trading is not only about charts or candlesticks. It is not only about technical indicators either. Trading is also about you and your thoughts. It is about your feelings and how you act under pressure. The market is unpredictable every single day. It will test your patience often. It will test your discipline as well. It will test your emotional stability frequently. Stephen Hart explains that two feelings, fear and greed, act like silent assassins. They damage many trading accounts. Fear can make you freeze in place. Fear can cause you to exit a trade too early. Fear can make you avoid good opportunities. You avoid opportunities because you fear losing money. Greed, on the other hand, whispers in your ear. It tells you to hold on longer. It tells you to take another trade. Before long, fear and greed hijack decisions. They pull you away from your careful plan. Now here is the real danger to understand. When these feelings take over, you stop trading by logic. You stop using your skill. Instead, you end up gambling. Gambling is the fastest way to harm your account. The 90-day challenge trains your mind to stay calm. It helps when the market acts wild and chaotic. How do we do this in real life? The first step is learning to notice emotional triggers in your process. That is where journaling becomes essential to your routine. Writing things down may seem boring compared to clicking buy or sell. Still, your trading journal is a powerful tool you will own. After every trade, write down your entry, exit, and reason for the trade. Also write how you were feeling at that time. Were you anxious or overconfident in that moment? Did you enter because of a clear setup or because you feared missing out? Over time, this habit reveals clear patterns in your behavior. Example, journal entry for clarity. Date, 2025-01-10. Instrument, EURUSD. Entry, 1.1000. Exit, 1.1020. Reason, breakout setup. Feeling, impatient and rushed. Lesson, wait for setup confirmation. Use short lines like this so the journal reads quickly. After 1 month, you will see repeated entries. You will spot clear triggers to fix. Example, journal entry 2, date 2025-01-12. Instrument, GBP/USD. Entry, 12501. Exit, 12480. Reason, reversal pattern. Feeling, overconfident and tired. Lesson, avoid trading when tired. Example, journal entry 3, date 2025-01-20. Instrument, USD/JPY. Entry, 102W0. Exit, 150. Reason, trend continuation. Feeling, calm and patient. Lesson, trust, setup, and hold. You will begin to notice simple patterns like this. Every time you feel impatient, you jump into bad trades. When you are ahead early, you often close too soon. You close too soon because you fear a reversal. These insights are priceless. You cannot fix what you do not see. Stephen Hart also stresses the importance of having a clear trading plan. He stresses the importance of following it every time. Think of your trading plan as a safety net. It catches you when emotions push you into impulsive choices. Without a plan, every market move feels personal. With a plan, every market move becomes data you react to with logic. You react with logic, not with panic. Even with a plan and a journal, you still need mental conditioning. That is where simple mindfulness exercises help you. This does not mean you must meditate for hours on a mountain. Mindfulness in trading means noticing your thoughts and feelings in the moment. It means not letting those thoughts and feelings control your actions. It is about catching yourself in the split second before you act. Ask yourself, am I following my plan, or am I reacting to fear or greed? This question matters most when the market moves fast. Short, mindful breathing example. Close your eyes and take 5 steady breaths. Breathe in slowly for 4 seconds. Breathe out slowly for 4 seconds. Notice your heart rate and your passing thoughts without judgment. This tiny pause creates space to choose calm action instead of an impulsive response. Use this breathing routine whenever your heart races or price spikes. Example pre-trade checklist. Check trend direction and time frame first. Confirm support and resistance levels visually next. Confirm risk per trade equals your planned limit. Set stop loss and take profit before entry. Note your feeling and confidence level in your journal. Timed drill example to build discipline. Set a timer for 60 seconds before each trade. Use that minute to check checklist items and breathe slowly. Picture this scenario as you listen. You are in a trade and price suddenly spikes. Your heart begins pounding in your chest. Your instinct screams, "Close it now." Meanwhile, your strategy says, "Wait for confirmation." This is when mindfulness saves you. Mindfulness gives you space to breathe and think. It helps you make the right call instead of the emotional call. The beauty of this 90-day challenge is that it does not ask you to become a robot. You are not trying to erase feelings. Removing feelings is impossible. You are learning to manage feelings so they do not manage you. Just like a professional athlete feels pressure before a big game, a professional trader feels adrenaline during volatile markets. The difference is that professionals use that energy wisely. They avoid costly mistakes. Most beginners overlook this point. Managing emotions does more than protect profits. It also protects your confidence. Each time you act calmly and follow your plan, you build trust in yourself. That trust forms the base for steady trading success. Think of your trading journey like building a house. Your strategy is the blueprint you follow. Your risk management is the solid foundation below. Emotional control becomes the frame that holds everything up. Without that frame, the whole structure can collapse in a single bad day. Over these next 90 days, make this mission your top priority. Notice when fear or greed starts influencing your decisions. Record your emotional state in your journal after every trade. Refocus on your plan whenever you feel the urge to act impulsively. Use a short mindfulness technique to reset when emotions spike. If you commit to these habits, you will not only survive the markets, you will also start trading with clarity, confidence, and control. Remember this simple truth. In trading, your biggest opponent is not the market itself. Your own emotional impulses are your strongest rival. Master those impulses, and you will be ahead of most traders. Stay calm and stay focused each day. Keep building your trading mindset one day at a time. Now let us focus on building confidence and trusting yourself and your strategy. Confidence in trading is not arrogance or overestimating skills. Real confidence comes from deep, steady trust in your process. It comes from trust in the rules you follow and in yourself. Without that trust, every trade feels like a coin flip. Every small loss then feels like proof you are not cut out for this work. Stephen Hart explains that true confidence does not come from winning every trade. No trader wins every single trade. Instead, confidence comes from knowing your strategy works over time. This remains true even when individual trades go against you. To build that belief, you need proof. Backtesting gives that proof. Backtesting is like interviewing your strategy before hiring it. You take your rules and test them on past market data. See how the rules would have performed in different market conditions. Test in trending markets and in choppy markets. Test in high volatility and in low volatility conditions. When you test properly, you do not only collect numbers. You gain calm, steady confidence. You will see that your strategy can survive bad days. You will see it can recover from losses. You will see it can still deliver results over the long run. Example back, test plan. Choose 6 months of recent data to start. Run your rules with a position size that risks 1% per trade. Record win rate and average gain and loss. Repeat on different months and note performance changes. This simple routine gives proof and reduces doubt in live trading. Risk management example with numbers. If your account size is $10,000 and you risk 1%, then risk per trade equals $100. If your stop loss is 50 pips and each pip equals $2, then the pip cost equals $100. In that case, position size equals the size that makes stop loss cost equal $100. Write this calculation in your journal so it is repeatable and clear. Once you have that proof, a shift happens inside you. In a live trade, you stop thinking, "I hope this works." Instead, you think, "I tested this. I know my edge. I will execute." That mindset change is large. It keeps you calm when others panic. The 90-day challenge does not stop at backtesting alone. Hart emphasizes daily trade reviews as well. That means after the market closes, you sit down and review every trade you took. Review wins, losses, and break-even trades equally. Ask yourself clear questions. Did I follow my rules? Did emotions affect entry or exit? And what could I improve? Doing this each day reinforces trust in your system. You will begin to see patterns. Maybe your best trades happen in the morning session. Maybe your worst trades happen when you break your own rules. This awareness builds stronger belief. You are proving day after day that discipline works. Journaling plays a big role here again. This time, the journal becomes a confidence log. Record wins and losses, yes. More importantly, record why trades worked or did not work. Build a library of lessons you can read when doubt appears. Revenge trading example for clarity. You lose a trade and feel angry and impatient. You immediately take another trade to try to win back losses. That second trade breaks your rules and raises risk. Record this pattern. Stop revenge trades by enforcing a cooling off period instead. Weekly review template example. Example: list each trade and the main reason for entering. Note repeated emotional triggers you saw during the week. Count how many trades followed your plan and how many did not. Set one specific rule to improve for the next week. Here is where many traders go wrong. They measure their worth only by profit and loss. If they have a green day, they feel great. If they have a red day, their confidence drops. Hart warns strongly against that trap. Focus instead on the process and on things you can control. Ask yourself, did I follow my setup? Did I stick to risk rules? And did I avoid revenge trading? When confidence rests on process rather than outcomes, losses do not shake you as much. You will learn that a good trade taken for the right reasons can still lose. That is acceptable because process over time makes profits. One strong side effect of steady confidence is this: it defeats two of a trader's worst enemies, fear of missing out and self-doubt. When you believe in your edge, you do not chase every random move. You know your setup will appear again. When you take a loss, you do not question your career choice. You log it and move on. Confidence also changes how you show up each day. Instead of sitting at your desk feeling anxious, you will feel ready. You will be in the market to execute a trusted plan. That change turns trading from a stressful gamble into a professional activity. Over the next 90 days, follow these commitments. First, backtest your strategy on at least 6 to 12 months of historical data so you can prove it works. Second, review every trade each day while focusing on the decisions behind the numbers. Third, journal your process and record both good and bad trades so you can track growth. Fourth, measure success by discipline rather than only by profits. If you follow these steps, something important will happen. You will stop searching for magic indicators, hot tips, or perfect setups. You will realize your edge was already there and simply needed your belief. Keep in mind that confidence does not mean you expect the market to go your way. Confidence means that no matter what the market does, you will stick to your plan. That steady confidence builds profitable traders. Remain consistent and remain disciplined. Trust yourself, because if you do not, the market will not reward you. Now let us focus on discipline and consistency. These are the backbone of trading success. If confidence is the fuel that keeps you moving, discipline is the engine that keeps you moving in the right direction. Without consistency, that engine can stall, sputter, and stop. Stephen Hart calls discipline the core of his 90-day challenge. Without discipline, everything else falls apart. You may have the best strategy and the sharpest analysis. You may have advanced tools too. Without discipline to follow your plan, those advantages mean little. So what does discipline look like in daily life? Discipline is not rigid for its own sake. Instead, it means creating and following a structured routine. This routine prevents impulsive and emotional decisions. Hart explains that discipline begins with basics. Set specific trading hours so you are not glued to the screen all day. Avoid chasing random moves that tempt you. Follow risk management rules every single time without exceptions. Do not increase position size out of frustration or greed. Avoid overtrading even when temptation feels strong. These small, consistent actions separate amateurs from professionals. Now consider consistency and how many people misunderstand it. Many traders think consistency means making money every day. That idea misses the point. Consistency means showing up with the same focus and process each time you trade. It means building habits that make good decisions automatic. Think of a professional athlete who trains even when they do not feel like it. They show up rain or shine and put in the work. Traders need that same mindset because the market rewards discipline over time, not random bursts of effort. One simple and effective way to keep discipline is daily journaling. This practice is more than recording trades. It is about holding yourself accountable. Ask, did I follow my plan today? Did I stick to my risk rules? And did I avoid overtrading? Writing these answers down forces honest review. Hart points out journaling helps you see recurring patterns. Maybe you break rules when tired, or maybe you overtrade after a big win. These patterns act like warning lights and tell you where to tighten discipline. Accept this reality. Discipline does not mean never making mistakes. Every trader slips up sometimes. But with a consistent routine, those slip-ups become rare. Recovery then happens faster. Without a routine, one bad decision can lead to a week of mistakes. The real power of discipline and consistency shows in your mental state. When you stick to your process, you start to feel stable even in chaotic markets. The ups and downs do not shake you as much because your job is to execute your plan without deviation. This mental toughness stops you from chasing quick wins or jumping into random trades out of boredom. Instead, you learn to wait patiently for your edge to appear. When it appears, you take the trade with full confidence. You act because the trade meets your rules, not because you hope it will work. Hart is clear that discipline was the key to his path to profitability. Early in his career, he made common mistakes like breaking rules, overtrading, and letting emotions take control. Once he committed to a strict routine, everything shifted. Trading then became less stressful, more predictable, and more profitable. Over the next 90 days, focus on these actions. First, create a structured routine that includes trading hours, prep time, review time, and scheduled downtime. Example routine: 2 hours prep, 3 hours trading, 30 minutes review, and 1 hour total downtime. Second, always follow risk rules and never increase size out of frustration or greed. Third, journal every day, and even on no trade days, record what you learned or observed. Fourth, review consistency weekly and track how often you followed your plan to aim for steady improvement. Practice idea for the 90-day challenge. Do a 5-minute drill each morning and review one previous trade. Do a 30-minute session twice per week for backtest study and journal updates. At the end of each trading week, perform the weekly review template and choose one habit to improve. Remember this trading rule. The market does not pay for big trades alone. It pays for making the right trades consistently over time. Discipline is the only reliable path to that result. Discipline protects you from impulsive action. Consistency turns good habits into second nature. Together, those qualities create a trader who can weather storms and survive drawdowns. They help you keep growing year after year. Commit to the process and show up each day with purpose. Let discipline and consistency be the pillars that support your trading success. This is the essence of the 90-day trading psychology strategy. It is a simple but powerful plan to help you control emotions, build lasting confidence, and stay disciplined no matter what the market throws at you. Remember that it is not only about making profits today. It is about building the long-term mindset that keeps you profitable for years to come. Start applying these steps and remain consistent with your practice. You will notice change in your trading. You will also notice change in how you approach every important decision.